In the second part, we talk about income recognition. Similar to the valuation of assets and liabilities in balance sheet, there is also a trade-off in income recognition. Actually, the process of recognition is to make an entry to record a transaction or event. In other words, income statement is to record all the operating activities change the financial position. Okay, so balance sheet shows the financial position at a point of time, while the income statement shows the change of all the financial position during a period. So when we make any journal entries, we record the change of the assets and liabilities. And the income statement play an important role to record the change of the financial positions. However, we cannot record everything, all the transaction and events. Although we try to report complete information, but in reality, not all the change can be reported. Reporting cash inflows and outflows is reliable, but is often not relevant for predicting future cash flows. We know this information we report in the statement of cash flow, which we will discuss in next chapter. Cash flows are reliable because we only record cash inflows in the statement of cash flow when we receive cash, either from customers or from shareholders or from creditors. Or we only record cash outflow in the statement of cash flow when we pay cash to either suppliers, investors, or creditors. However, this information do not reflect the economy of the business, so it does not help us to predict the future cash flows. So statement of cash flow is not used to predict future cash flow. It's just recording the historical cash flows. To predict future cash flow, income statement is more important. Actually, statement of cash flow is good to assess the financial risk of the business. Okay, there are three approaches, but we apply the approach 2, which is a hybrid of approach 1 and approach 3. Similar as balance sheet valuation, we also have 3, right? But actually, we apply the mixture of both 1 and 3. So what approach 3? Actually, income statement adopt the approach 1. Okay, so the recognition is when the revenue recognition is when the revenue is earned. Right? Actually, that's the characteristic of accrual accounting. We focus on economic activities rather than cash flow. So when realized, when the product is delivered or goods delivered or service provided or rendered. Right? So in the income statement, we only record realized earnings, realized expenses. So approach 1 recommends only record realized items. So anything, the economic activities actually take place. Approach 3 recommended when the change occurs. It may not be realized, but if it occurs, we can record it. The example is like the financial assets. So we know the financial assets, every day the value of the financial asset changes, right? So if a firm invests is a shareholders of other firms, so this financial investment, the value actually can go up or go down. Right? We know the stock market, right, fluctuate. That means the gain and losses occur every day. So the third approach is focused on whether the value change occurred. If it occurred, we record it. So actually this part we applied in the balance sheet as other comprehensive income. So this part actually bypasses the income statement. So currently the income recognition, we recognize two different income. One is realized income, the other is gain occurred. So for the realized items were recorded in the income statement. Okay, for the revenue, expense, and the bottom line net income are all realized. So any value changed or occurred, we recognize as other comprehensive income, as one of the account in the stockholders' equity. So right now we apply both approach 1 and approach 3 and report it in different financial statements.